So Bitcoin miners have seen their margins slashed, power costs surging across North America, and revenues dwindling along with the price of Bitcoin. Yet CleanSpark rather, is in a position to be buying. How is that?
Well, first of all, thanks for having me. It's great to be back and have an opportunity to chat about it. But if you kind of rewind back to September, October of November of last year, there was essentially an arms race for mining equipment, and we made the decision at that point in time to focus not on future contracts of mining rigs, but rather on securing the proper infrastructure. So at the time, many of our peer group were paying $80, $85, $90 a terahash for the new latest generation mining rigs. We through our analytics kind of came to the conclusion that there was going to be a bit of an oversupply when it came to mining rigs, and many of these companies weren't factoring in difficulty. So we made some big investments in infrastructure, immersion cooling, expanded our nuclear power at our facility, one of our facilities in Georgia, decreased our cost of mining, and then kind of stood back and waited for opportunities. And as you mentioned, we picked up 1,800 of the newest Bitmain S19 XPs, as you said, from another miner that put a deposit down 2 or 3 fiscal quarters ago and then didn't have the ability to pick up the miners. So we found ourselves with the unique opportunity to be buying some of this equipment literally at fractions of a dollar compared to where our peer group was. The one last week was unique in that those 1,000 plus rigs were already plugged in and hashing. So we're seeing a tremendous amount of opportunity and look to take advantage of it.
Well, that was a really smart move back in the fall. Yet now, as I mentioned before, that we're seeing a lot of miners capitulating, the price is down, energy costs are higher. How is that impacting CleanSpark and other miners like yourself?
Well, it certainly has a massive factor on everyone. Energy costs are the largest cost of mining Bitcoin. So being strategic in our approach and securing power purchase agreements, as an example, we publicly disclosed that at our facility in College Park, Georgia, we pay 2.85 cents per kilowatt hour for electricity, and it's 95% nuclear. So by focusing on efficiency, reducing our power usage equivalent, maximizing the value of our mining operations, we've been able to maintain a fairly strong profit margin even under this pressure. Additionally, we were excoriated back in November when we publicly announced that we believed that the timing was appropriate to begin to use our Bitcoin that we had mined as one of the levers in our capital management strategy. So back when Bitcoin was in the $60,000 and $50,000 price range, we began to sell that Bitcoin for reinvestment in CapEx and OpEx, with still an extremely bullish thesis on the underlying commodity, but understanding that a miner can't operate in perpetuity with a 100% HODL strategy because somebody has to pay for the expenses. So we took an approach that we would reduce dilution and focus on utilizing debt and Bitcoin back then. Now it's become much more in vogue as companies have actually been forced to do so, not without a lot of pressure from some of the creative, unique, leveraged positions many of them found themselves in.
Yeah, it's interesting how you have to balance the trading side as well as the business side. And $60,000 Bitcoin sell, looking back, was a good trade. And I wonder, it must be about, we're seeing a lot of leveraged crypto firms right now bear the pain right now, amid this bear market. So I wonder your thoughts on that, because there are other miners who are also taking on huge debts and liabilities. And so is it a matter of keeping those low?
Well, it presents a unique challenge. In fact, just before we came on, they were talking on CNBC about a couple of things. First, that the SEC has asked Congress for the ability to hire 125 more enforcement agents, and they spoke specifically about how that pertains to crypto, and they pointed to the recent massive bankruptcies. The story immediately preceding that talked about Celsius and their terms and conditions, talking about that when someone made a deposit there, that they effectively transferred ownership of the Bitcoin that was held on that exchange, and it allowed them to leverage those reserves. What happens is you promise 17, 18% APY on yields on Bitcoin. That works great as long as Bitcoin only goes up. But in a real world environment, what happens is when the market corrects, now you've got withdrawals and notifications. And so what's happened is that, to Charlie's point earlier, many of the institutions seeing 17 or 18% promised annual returns saw Bitcoin as a Ponzi because of that kind of inappropriate management strategy. So while it's unfortunate, and there have been a lot of people that have been adversely impacted, for miners that have been conscious of what's actually happening in the industry, not taking any risks with leveraging the Bitcoin, not taking risks with massive debt, being mindful of dilution, it's enabled us to be positioned such that, like we talked about before, we're picking up assets at 20 cents on the dollar or less from where we were seeing them just 2 or 3 fiscal quarters ago. So it creates opportunity, and that exists regardless of the underlying commodity, whether you're talking about gold or oil or anything else. It creates unique opportunities, and some companies have been fortunate to be positioned to take advantage of those, and we're happy to be where we are.